Let's get to what all of this means for the U.S. economy. We're joined by Paul Gruenwald, who's S&P Global Ratings chief economist. Paul, it's always great to see you. So as we look at this stimulus package, as well as perhaps more importantly, the vaccine deployment, is this going sort of as you expected? And does this feed into the narrative that we're even going to see GDP numbers higher than a lot of economists are predicting for this year?
Yeah, hi, Julie. That's absolutely right. You guys already pointed to a couple of things that are making us a little bit more optimistic about our forecast. First, the vaccine rollout seems to be happening sooner and faster than we thought. The stimulus plan is now passed, 1.9 trillion. That's going to give a good short-term boost to U.S. growth. And then we had a better Q4, not just in the U.S. and globally, and the data flow has been better. So when you put all those three together, that makes for a stronger forecast. We're just starting our Q1 forecast now, but I would say there's a meaningful upside risk to our U.S. growth forecast that we made back in December. That was 4.2% for this year.
And, Paul, maybe thinking more broadly outside of what the exact number may or may not come in at, as you think about the trajectory now that it seems the economy is on, are you starting to, think about us getting back towards trend growth significantly faster than we did after the great financial crisis, and really being able to avoid a replay of that kind of lost decade?
Yeah, I think our general view is that this is a very different crisis than the global financial crisis. That was, in the end, or at the beginning, a financial crisis, and those excesses need to be worked off. So this is more of a, kind of dial on, dial off crisis. Once we get the vaccine rolled out, once we get herd immunity, although we're not totally comfortable with that term, it's not a switch, but then we'll be able to re-engage in all these sectors that have been hit hard, right? Food and beverage, airlines, entertainment, the parts of the economy that have been shut down. So if all of that happens sort of as planned or as we're currently thinking, we could be well north of potential growth this year. The U.S. will get back to pre-pandemic GDP levels probably in the second quarter of this year rather than the first quarter. And then eventually, we want to settle down at around 2% growth again in the U.S. But, that's still going to take a couple of years. And, the Fed's going to wait until they see inflation. So it's not a 2021 story, maybe not a 2022 story, but we should be having higher than average growth for the next few quarters and then sort of converging to that path you're talking about.
Paul, you're looking for orderly reflation. What is orderly reflation?
Well, first of all, reflation is good, right? So I think there's been a little bit of scare in the market recently. It almost sounds like, we're back in the 1970s with double-digit inflation, oil price shocks, Fed taking away the punch bowl, all that kind of stuff. What we're looking for is basically a rise in nominal numbers that we really haven't seen since the global financial crisis. So, getting the Fed and other central banks off of zero and more toward their long-term, short-term policy interest rates, which according to the dot plot's about 2.5 for the Fed. If the Fed's at 2.5, what does that mean for the 10-year? That's probably low to mid 3. So we've got a ways to go from where we are now to there. That's going to remove some of the distortions of low interest rates. It's going to lessen the search for yield and some of the other things we've been talking about for quite some time. We obviously want that transition to be as smooth as possible. If some sectors are way ahead or behind the general economy, that could create pressures. If we have volatility in markets, let's say, spike in risk aversion, that would be difficult for funding. So it's never going to be a totally smooth path. But I think our argument is we recognize that reflating these nominal variables is generally a good thing. We shouldn't say that, we're worried about an uptick in inflation or growth or nominal GDP. We're kind of hoping, it's not a forecast, we're hoping that we can get there on a relatively smooth path because that's the end goal. The end goal is an economy that's reflated with higher nominal growth values.
So, Paul, as you think through how that path is going to look and potential risks to your outlook, because there's not a lot of talk of risks these days, is there, to the economic growth? Is sort of a painful reflation process, is that the biggest risk, or is there something else or some things that you're paying attention to?
Yeah, we're having a lot of discussion, with our colleagues in S&P Global Ratings, and we're talking a lot about the potential unevenness. If the U.S. gets too far ahead of the rest of the world, you guys just talked a little bit about Europe, but if the U.S. gets too far ahead, the dollar strengthens, U.S. rates are much higher than other advanced country rates. That could be a potential problem for some emerging markets that borrow in U.S. dollars. If some sectors are struggling to rebuild after the restrictions are lifted and their earnings aren't catching up with the interest bill, which is going to be rising as we reflate, that could be potential problems. If the U.S. is a consumer-led economy and China and Asia still are running supply and trade-led economies, global imbalances could widen and markets don't like that. So there's a lot of sort of dimensions to this uneasiness we're looking at. I mean, general market volatility is something that's gonna happen, but hopefully these big gaps we've seen between countries, between sectors, between other things, they start to narrow as we get to a sustained recovery. But those are the sorts of things we'd be watching over the next year or two.
Gotcha. We'll be watching them too. Paul Gruenwald, thank you so much. S&P Global Ratings Chief Economist. Good to catch up with you, Paul.